Thanks very much, and good evening, everybody. And thank you for your time and your interest in what we do. And thank you also to AJ Bell for this opportunity. So I should start off by saying that I'm going to talk about the long term, and I ought to inform you that I've also tried to deploy those approaches in my own career. So I've been managing the portfolio for just under a quarter of a century, which is a slightly terrifying fact to reflect on. But what I want to talk to you about today is what you should expect when you look at this trust. I think it's very important that shareholders and prospective shareholders of a trust understand what it is they're engaging with. So a good place to start would be, very simply, what are we trying to do? If you were to open the annual report of our trust and look inside the front cover, you'd see this rather anodyne corporate language, which is our investment objective. And it simply says that we're trying to maximize total return from emerging markets worldwide through a diversified portfolio. I hope I can expand on that a little bit and make it a bit more real in the next few minutes. I also should say that I interpret that as meaning we should be trying to give our shareholders good returns in exchange for the risks we assume with their money. And to do that, we need to have a consistent process, and we need to apply that process in a consistent way. So how do we go about that, and how do we invest the shareholders' money in this trust? There's one thing above all that I'd like you to take away from that, and I know I'm not the first person this evening to talk about this, but I'll show you some numbers later to prove that I really mean it, and that is time horizon. We are unashamedly long-term investors. In fact, I've spent most of my career being criticized for not trading more actively in the portfolios that I manage. I've had many arguments over the years as to why I don't think I should do that, but we are really long-term investors, and we do that for very simple reasons. We want businesses to compound in value, and things which compound successfully at a rate above average eventually dwarf everything else, and that's what we're trying to do. That's the first thing that I'd like you to remember. The second thing is that although I am an emerging market investor, I can look at many countries around the world, and indeed we do, from Chile round to China. We are not investing in countries, we're buying companies. Very often I get asked, what do you think of India? What do you think of Malaysia? What do you think of Brazil? And my answer is always the same, which is, I have some opinions about these countries in a nebulous sense, but it's the wrong question, because we don't buy Brazil any more than someone who owns investments in the UK buys the UK. You know, if you were invested in the UK stock market many years ago, you could have bought ARM and been subject to one of the biggest corporate takeovers eventually in British corporate history, or you could have invested in Carillion and see it go to zero. So what did you think of the UK? Not a relevant question. We are investors in businesses, and I'll talk a little bit later about some of those examples to break it a bit more real for you. And finally, it's also worth saying that we don't just care about what companies do, we also care quite a lot about how they do it. And that is not a holier-than-thou attempt to save the world while also making money for our shareholders. But I would say that sustainability in businesses, and particularly if you have a really long-term view, the ability of a company to sustain and grow its value, of course, is a very important factor for you. And that includes, but is not limited to, how companies think about their environmental impact on the world, how they conduct themselves socially, and what kind of governance structures they bring as well. So we are interested in the broad sustainability of the businesses for the simple reason we hope that they will sustain and grow their value for our portfolio and for our shareholders. So let me just go back to this point about taking a long-term view. If you think about it, if you're an equity investor, there are only 4 ways you can make money. You get a dividend. If the company's profits grow, that dividend can grow. And on any given day, the valuation might be higher or lower than the valuation the day before. And if you invest in a second currency or another currency, the currency rate will go up and down overnight as well. And what's important to understand, and the reason I put on the headline here, a famous quote from Ben Graham, arguably the inventor or founder of the professional investment industry, who said, in the short term, the market is a voting machine. In the long term, it's a weighing machine, is because it's true. When you look at this graph, and I'll just take a moment to explain it, the way that you make money changes dramatically depending on how long you stay with an investment. Not surprisingly, if you buy a share today and sell it tomorrow, chances are you didn't get a dividend. You've no idea what the corporate profit growth is going to be because you haven't had any more results. But the share price isn't necessarily the same because the valuation of the currency might move a little bit. And so the green and the gray bars constitute the entirety of your short-term return. On the other hand, In emerging markets, and I think this is not just true of emerging markets, once your holding period goes out towards 10 years or so, the entirety of your return is arising from dividends and growth in those dividends funded by growth in profits. And that is what we're about. So we are concentrating on businesses which grow their intrinsic value. We are not trying to trade little valuation anomalies in the short term. That has the incidental benefit, I should add, of lowering the running costs of the portfolio very considerably. And that is not an insignificant consideration when you're invested in markets where, by and large, transactions are still much more expensive to carry out than they would be in the developed world's equity markets. So if we're long-term business investors, can we show you that and can we prove it? Well, here are the top 10 investments of the trust at the midpoint of its current fiscal year. That's the end of last December. And I originally put this slide together for an AGM partly in an attempt to persuade people that I do occasionally buy new stocks. And in fact, half of the top 10 positions in the trust have gone in the last 5 years, although realistically, we've only made 2 large, significant new investments in the last 2 years. But I'd also draw attention to the top of this table where you can see a couple of names, HDFC and TSMC, very different businesses, which we've owned continuously now for just over 20 years. And in fact, HDFC in particular, which is the trust's biggest holding at the close of last year, is a stock which we bought in 1998. I have reduced it once, and I bought it back again about a year afterwards. And that's the only time we've transacted in that security. So if you want some demonstration that when I say we're long-term investors, I actually mean it, I point you towards this table as a good indicator of that. And all we're trying to do, really, is to buy good businesses and keep them for a long time. It sounds very simple, but something I believe strongly in is that doing nothing is actually far more difficult than it sounds. As a professional investor, as my colleagues at the front row will know, you are surrounded and deluged on a daily basis by people trying to persuade you to change something. Almost all those people, incidentally, have a vested interest in trying to make you change the portfolio. And I take a certain degree of pride in not changing the portfolio every day, and indeed sometimes not changing it for months on end. That's the only way you can really get the benefits of compounding over the long term, is if you're prepared to sit there and let things happen and not react to them. So we buy good businesses and we keep them for a long time. The second point is we buy companies, not countries. And I've just chosen a couple of examples to demonstrate why we do this. Now, to do this, I wanted to go to an industry where you might think there isn't a lot of difference between 2 companies in the same country doing the same thing, and that is financial services. After all, a bank is ultimately a bank, a life insurance company is ultimately a life insurance company. So these 2 charts show you, in each case, a pair of companies operating in the same industry, in the same country, with very different outcomes. The top chart is the Chinese life insurance sector. Now, if you go back 15 years or so, China Life, a large state-owned, government-run business, was the biggest life insurance company in China. And that is the wobbly yellow line towards the bottom of the chart. On the other hand, there was a fairly new, relatively recently founded business called Ping An, which a couple of my other speakers this evening have mentioned, a private sector company with a very dynamic and totally different attitude, especially towards the use of technology in their various businesses. Nevertheless, it is basically, underneath all that, still a life insurance company. You might think, how is it that one company in the same industry can outperform another by such, not by fractions, but by multiples over a 15-year period? It's ultimately all down, especially in a business like financial services, to better management, to better decision-making, to better incentivization structures, and better execution. And the second example, which is very similar, this time drawn from South Africa, is of 2 banks. One of them is Nedbank, the other is a small challenger bank founded with an extremely low-cost base to serve low-income customers called Capitec. And here, if anything, I think the differences are even more remarkable because one of them has outperformed the other by something like 10 times in the last 5 years. And those are 2 companies doing the same thing in the same country. And that is what we are after. The reason we buy companies, and we think mostly about companies, is ultimately that's where the opportunities lie. It's not about countries. Countries don't outperform each other except in the most nebulous sense. So we're investors in companies and businesses and not in countries. I'm not going to dwell on performance. Everyone has to have a slide. I've got a slide. Please look at the numbers and make your own judgments at the end of it. But suffice to say, I wouldn't be standing here if these numbers were absolutely terrible. And the final thing I want to say is just a word about sustainability. And this is an output and a measure. This is not the only measure, but I do think this is something that it is worth highlighting. And this data on this slide is from Morgan Stanley, which runs, among other things, a service to judge the carbon footprint of investment portfolios. And I mention this because you might think emerging markets, lousy environmental standards, lousy government, lots of corruption, surely businesses just make things cheaply and flog them. It's not necessarily the case. And I particularly highlight this because I also think it's a great advert, frankly, for active management. If you bought an ETF on the emerging market benchmark, $1 million, if you're fortunate enough to have $1 million to invest, would generate roughly 15 times more carbon output than the companies we own in the JPMorgan Emerging Markets Investment Trust. That is a really serious environmental difference at the end of the day, particularly when compounded over multiple years. And it's not achieved by accident. Part of it, of course, is down to the kind of businesses we invest in, but part of it is down to the way those businesses are managed, the decisions that the owners and managers of those businesses make in tiny operational details every year. One of the companies we own in the trust, incidentally, and just to give you an example of these kind of decisions, is an Indian beer company. And it's now, well, it's not quite, but it's largely invested by the Heineken Group, who have some influence in the management. And it's very interesting talking to them about issues like sustainability, where their goal is to ultimately go towards what they would call water neutrality, which means it takes 1 liter of water to make 1 liter of beer. If you go back a few years, it used to take them 7.5 liters of water to make 1 liter of beer. They've now got it down to about 2.5. And in case you think it's all good intentions and motherhood and apple pie, it's very interesting to hear them saying, frankly, when we started this, we thought it was about corporate branding and being a responsible citizen. What we didn't understand at the outset was just how much more efficient this kind of mindset would make us. It's lowered our costs, it's lowered our manufacturing expenses, it's made us a more competitive business because we've been thinking about these kind of things. And we find in general that companies that do one kind of thing well tend to do a lot of things well, which is yet another reason to think about this stuff and ultimately to try and identify the businesses which perform best in these sort of areas. One other point I want to make, which is it's a very big world out there, and I work for a pretty large company within that. And I think it's also worth saying that I have to turn that to my advantage. So although you will often see me standing up talking about the trust, I don't do this on my own. In fact, we have a large team at JPMorgan. And we've spent a lot of time in the last 15 years or so building a research team which covers the world, as I said before, from Chile round to China. We have, in fact, something like 95 dedicated investors working on emerging markets in Asia Pacific at JPMorgan. We are in 8 locations. We speak 21 different languages. We have something like 17 different people on our research team following purely A-share companies in China. That's domestically listed stocks in China, which have recently become available to us as investors. And I think that without the large resources, it wouldn't be possible to deliver the kind of results that we've been able to do. So I put this slide up partly to make you believe these people really exist, partly because I think I shouldn't take all the credit for anything that we've achieved. It's not a solo effort, it's a team effort, and we're fortunate to have the kind of large team that I mentioned. Let me sort of stop there and talk a little bit about a couple of things in the portfolio, just to make it a bit more real. And you might think emerging markets, well, what is that? It's probably a bank, maybe there's a telecom company, there's usually a beer company somewhere. And indeed, 25 years ago when I started doing this, that was probably it. A lot of utilities, a lot of financial services, a bit of real estate. It's very different now. And the world, particularly the world I look at, which has changed, I think, more rapidly than the world that I live in on a daily basis, has changed very significantly. And to show you that, I've taken 2 of the stocks that we own. One is one of the largest companies we hold in the portfolio, and one is one of the smallest. So the first one, in terms of talking about things we actually own and have owned in some cases for a long time, is a business called Taiwan Semiconductor. It is the world's leading, and I mean leading without any exceptions. I don't mean leading in emerging markets. I mean leading, including America and everywhere else. It is the world's leading producer of semiconductor chips. If you have an iPhone, the chances are the semiconductor chip inside it was made by this company. This is an incredibly high-tech manufacturing business. We're dealing with resolution in the manufacturing process of fractions of the width of a human hair, and a speck of dust is a real problem. So these are clean manufacturing facilities which cost billions to construct, full of people walking around in white suits, manufacturing incredibly precise, high-tech components which power ultimately pretty much all the technology in the world. This is a business we've owned, as I said earlier, for 20 years now. And the other one, which in some respects is more surprising, this is a Taiwanese-based company, incidentally, and Taiwan has really now become the center of the world's global manufacturing of electronic products. But the other company I want to spend a moment on is a company called Globant. And Globant is a very small company. In fact, it's the smallest company that I've invested in the last 5 years. When we bought it, the market value was about $500 million. Call that £350 million. It made perhaps 15 to 20 million pounds profit a year. Really tiny business. It's a software services company, so it writes software for other companies. And the reason I have this large photograph of it is that one of its biggest clients is Disney. And it writes software for Disney. So it's an outsourced provider of software services, and it's based in Buenos Aires in Argentina, which is not where you would expect perhaps to go to find a successful software or IT services company. Globant is an unusual company. It's not writing code to run back-office systems for big corporations, which is how the Indian software industry really developed and made its mark. It's doing digitalization for its customers. And what I mean by that is it's doing things that touch the customer. The wristband here is something you get if you take your children to a Disney theme park. You use it to pay for the rides. And someone has to write the software to connect the accounting on the ride and the buying online of the ticket. But more than that, they also plug it into your identity. So when you buy the ticket to the theme park, you put in your child's name. And believe it or not, I find this slightly spooky actually, as your child approaches the giant Mickey Mouse figure, the wristband has your child's name on it. The costume has a screen inside. Mickey says, "Hello, Susan. I've been looking forward to seeing you all day long." And the software that does that is written by this Argentine company. So I use those two examples as perhaps some of the more surprising things that you might not have expected to find in emerging markets. Very quickly, what do we want you to remember? We're long-term investors. We have deep resources as a business. We have a consistent approach, and we've been applying it for a long time. But there's one other thing I'd just like to put in your minds, and that is that if that's the way we do it, it follows that is also the way that we think, ideally, the shareholders of our trust should do it. And this is the reason why. If you simply took the emerging market index, you've made over the last 17 years or so something like a 10% compound return. If you missed the best 10 days in those 17 years, you lost a third of that return. If you missed the best 30 days, you lost almost 80% of that return. You made 2% a year instead of 10. And if you missed the best 50 days in the last 18 years, you lost money. And I am here to tell you, I did not know in advance which days those were going to be. And therefore, the only way to capture those returns is to stay invested and to take a long-term view. And if you'd done that with the trust, which we manage, which was launched at £1 in 1991, you would today have a business whose share price is a shade under £10. And that is the value, ultimately, of compounding and taking long-term views about investment. So if we do it in the portfolio, we have to believe that it would be a good idea for our clients to do the same thing. Thank you very much for your attention, and we look forward to questions later.